When talking about stocks and investing, the term diversification gets tossed around a lot, and for some, it's good, but for others, it poses problems that prevent them from reaching their goals. When doing so, you do tend to spread out your investments, and as a result, dilute your returns, and we'd like to get into it a bit more. This is Income Intelligentsia, real-life advice for practical and financial goals. Today, we want to talk about diversification, why it doesn't work for others, and what is over-diversification. So let's get to it. Now, diversification is attractive to passive investors because one of the more popular ways to invest is through index funds, and those are automatically diversified because it replicates the market instead of trying to outperform it. In other words, it makes sense that it's popular because it's a safe tactic for people to use. Diversification is one of the most secure ways to make sure that your investments are protected. But too much of a good thing can be a problem. If it's too spread out, you risk the possibility of maximizing your gains on well-performing stocks and undervalued ones. Think of it like this. If you see a couple of companies flourishing and you want to invest into them despite the inherent risks of placing your money onto them and them alone, if you do so, you maximize the amount of income you gain as a result because you predicted right and you've done your analysis. Of course, this takes time and effort to study the market and companies in question, but if you're successful, active trading does help you get far. That said, that's not something you can do if you diversify too much, and instead, you lessen the amount of investment you could have into performing stocks. There are certain things that you need to consider when diversifying, and some of these arguments are concentration for potential high returns. Some investors believe that concentrating their investments in a few select assets or industries that they have deep knowledge about can lead to potentially higher returns. By focusing on what they understand well, they may be able to make more informed investment decisions. We talked about diluting your potential gains by diversifying instead of concentrating on well-performing stocks. Warren Buffett made his fortune by focusing on undervalued stocks and winning big as a result. But he did so by carefully scrutinizing the market and looking for valuable stocks that had good management and were priced lower than they should be. And while diversification is fine and is an acceptable way to build your fortune, being able to handle risk and making big decisions is also an important part of investing. Avoiding mediocre performance. Diversification can dilute potential gains from high-performing assets. If you spread your investments too thinly, you might have exposure to mediocre assets that drag down overall portfolio performance. The belief here is that it's better to go all in on what you believe will perform exceptionally well. This is why, in people's wealth building phase, they tend to concentrate on just having one fund in their portfolio, an all-stock portfolio. Whether it's an index fund or individual stocks, the stock market has the most potential for revenue over time if researched well. Granted, there's still some risk involved. It's still worthwhile to do your homework and have a good number of companies in your portfolio that you can manage. High conviction investing. Some investors have strong convictions about certain companies or industries and prefer to invest heavily in what they believe will succeed. They prioritize their highest conviction ideas rather than diluting their investments across a broad range of assets. There are investors that heavily believe in the capability of tech stocks, but due to the nature of their volatility because of market changes, competitors, and other big factors, it is risky and not suited for beginner investors. Reduced monitoring complexity. Diversifying a portfolio requires monitoring multiple assets and industries, which can be time-consuming and challenging. Some investors prefer a simpler approach where they can just focus on a few select investments and monitor them closely. If you're focusing on just one or two stocks, you'll be fine because while it isn't as passive as index funds, you don't have the hassle of managing multiple stocks under a portfolio with multiple asset classes. The idea here is that while it's simple enough to manage, it's also focused on stocks that are valuable and can grow from where you are right now. Costs and fees. Maintaining a diversified portfolio often involves transaction costs, management fees, and taxes. Concentrating investments might reduce these costs, potentially leading to higher net returns. Expertise and knowledge. Some investors believe that they possess specialized knowledge or expertise in a particular sector or asset class. They may feel confident in their ability to predict trends and select investments within that niche, opting for concentration in what they know best. This is why, if you're someone that prefers tech stocks, you may be inclined to invest heavily in that despite the volatility. There's no question that technology plays a huge part in the market, and there are certain swings that allow different companies to perform well. However, those that are informed enough to make decisions involving tech stocks end up doing fine. While these reasons against diversification may be valid for some investors, it's important to remember that diversification is still a widely accepted technique for risk management and obtaining more stable, long-term investment results. Every investment decision should be carefully reviewed in light of the investor's risk tolerance, investing objectives, and a thorough awareness of the potential risks and benefits associated with each method. Consultation with a financial advisor can provide useful insights into tailoring an investment strategy to your individual circumstances and goals. And while that's the case, there are some other arguments against concentrating your stocks. You have to actively research the market for good stocks and manage your portfolio. It can be time-consuming, and if you concentrate your investments in a single industry or sector, you're exposed to specific industry risks. Economic downturns, regulatory changes, or adverse events affecting that industry can significantly impact your portfolio. There's also the factor of emotional stress. Think about it this way: if you're concentrating heavily on stocks, there's no doubt that market changes are gonna be there. For some, short-term changes are hard to deal with, but most successful investors tend not to be bothered by it and instead try to look at it from a long-term perspective. Since you're buying stocks and essentially part ownership of a company, worrying about short-term volatility isn't as productive as looking at it as a whole. Remember, if you pick a good company with good management, a good place in the industry, and is financially stable, you have a better margin of safety as opposed to the contrary. If you're not a professional stock trader or you aren't interested in becoming one, then some investors prefer extreme diversification. This essentially takes the legwork out of investing and just lets your money grow with the economy over time. This approach is good for investors that believe that the economy will do well in the future and expect their portfolio to just replicate the market through index funds. Warren Buffett initially didn't want to diversify his asset classes during his wealth building phase because he believed in building his wealth through active investments. Making decisions and evaluating businesses is active investment. Your portfolio would be better if it wasn't diversified due to the very simple reason of stocks potentially performing better if actively managed. In summary, the key points to realize here are: there is potential for high returns, deep understanding and expertise is needed, strategic bet on convictions can maximize your gains, avoiding mediocre investments helps you save money and can be allocated into better assets instead. There is better monitoring in managing just a couple of assets. Alignment with investment philosophy of selecting a number of undervalued assets can be good in the long run. It is critical to recognize that concentrated investing is a high-risk approach that necessitates a detailed understanding of the firms or industries in which you are investing. The possibility for larger returns comes at the expense of dramatically increased risk, as the performance of a restricted number of assets will heavily influence the performance of your portfolio. If you've enjoyed this video and found us helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you in our next video. Stay mentally healthy, and let's get financially fit together.